Hello everyone, today's presentation is called Understanding Passive and Aggressive Traders in Order Flow Analysis. My name is Michael Baltos. I'm the founder and trader at Orderflows.com. First, a brief disclaimer. This presentation is for educational and informational purposes only and should not be considered a solicitation to buy or sell a futures contract or make any other type of investment decision. Futures trading contains substantial risk and is not for every investor. An investor could potentially lose all or more than the initial investment. Risk capital is money that can be lost without jeopardizing one's financial security or lifestyle. Only risk capital should be used for trading, and only those with sufficient risk capital should consider trading. Past performance is not necessarily indicative of future results. Okay, so here we go. This is a footprint chart, an order flows trader footprint chart, and you can see, there's bids and offers, there's volume, there's numbers, right? And it's what the volume is traded on the bid versus what's volume traded on the offer. The market moves as people trade, as people sell into the bid or, people buy from the offer. That's what causes the market to move. If the market, if there's no trade going on, if it just stayed, say 43.76 bid offered at 43.76 and a quarter offer, we can trade there. It's when the market starts to trade above the current bid or below the current, above the current offer or below the current bid. When people are selling into the bids or buying from the offer, then you reach the next level. That's what causes the market to move. So, futures markets work in a two-way auction process. There's a bid and there's an offer. Okay, so for example, this blue area, you can see the bid. 20.50 is the bid, 20.50 and a quarter is the offer. There's size of 56 on the bid, 198 on the offer. So, technically somebody could sell 55 contracts at 20.50 and not move the market. Conversely, someone could buy 197 and not move the market. As soon as someone buys 199 contracts, they're going to take out all the offer and it's going to trade the next price up at 20.50.50. So for a trade to happen, someone has to sell into the bid or buy from the offer. Again, the market is a bid and it's offered, and it's just people are going to be bidding. 20.50 bid, 20.50 and a quarter offer. Well, they're not matched. The person wants to sell it at 50 and a quarter. Somebody wants to buy it at 50 and a half. So in order for a trade to happen, someone has to sell it at 50 even, or somebody has to buy it at 50 and a quarter. There's people willing to sell it here. There's people willing to buy it down here. But for a trade to happen, someone has to go to that other price. So the market won't move until trades occur. In markets where there's heavy size on the bids and offers, that's why you don't usually see much movement. For example, would be the 10-year notes. 10-year notes usually have, 2,000-3,000 lots on the bid. So it's going to take a lot more to move that market. In markets where the size on the bids and offers are much less, that particular market can move more easily. For example, crude oil. Crude oil, there's usually, maybe 5 to 20 contracts on the bid or the offer at any given time. So, you could sell 50 lots and move the market a few cents. Whereas, in a market like the 10 years, you could trade 1,000 lots and not move the market. Okay, so, a common phrase is, for every buyer there is a seller. You hear that all the time in regards to the markets. Now, what they don't tell you is there's different types of buyers and there's different types of sellers present in the market. And basically there's 4 types of buyers and sellers combined. You have aggressive buyers, aggressive sellers, passive buyers, passive sellers. Now, each one sort of has their own unique, I'll say footprint, but their own unique way of getting trades. And I'm going to talk about those here. So aggressive buyers are traders who buy from the offer. So example, when we're back at 20.50 bid at 20.50 and a quarter offer, an aggressive buyer is somebody that buys at 20.50 and a quarter. They're the person that's willing to pay the market price and buy it from the offer. On the opposite side, aggressive sellers are traders who sell into the bid. When it was 20.50 bid offered at 20.50 and a quarter, the person that sells into 20.50 is the aggressive seller. They want to get short. They're not taking their chance, working an offer. They just want to go ahead and do it. Aggressive buyers, aggressive sellers are people that trade at the market. They're not people that work limits. A passive buyers are traders who buy by working a bid in the market. So, you see the market's 20.50 bid at 20.50 and a quarter. Well, the person that's trying to buy here at 20.50, they're passive. They're letting the market come to them. They're not going to the market with a market order. They're working a bid in the market. And conversely, passive sellers are traders who sell by working an offer in the market. They're the offer, the 20.50 and a quarter. So, in a nutshell, right, you have basically your market is 20.50, 20.50 and a quarter. There's always going to be a bid and offer in the market. There's going to be rare circumstances like, say, markets limit up or limit down. Well, there's no bid, there's no offer. But, that's the exception. And it happens very rarely these days. So, the person that works a bid or works an offer is passive. They're letting the market come to them. Imagine you're trying to sell your house. You set a price, and if somebody is willing to sell it, or sorry, willing to buy it from you at your price, then great. But if you're trying to sell your house, say for $700,000, you're working an offer out there. You're a passive seller. You're waiting for someone to come up and say, yeah, I really want your house. I'll pay you for it. I'll pay you, what you're offering it at. I'll pay you the $700,000. Then, say somebody comes into your house. Yeah, it's a little small, but, I like it, but it's a little small. Maybe it's a little further from the train station that I'd like to be. I'd like it, but, I'll pay you $600,000 for it. So that's their bid. You're trying to sell it, so you're going to be working an offer. You're at $700,000. The person that wants to buy it from you, likes it, but doesn't like it for $700,000. Maybe they like it for $600,000. So they throw in a bid, see if you'll bite. If you'll if you'll sell it to them for $600,000. If you say, hey, yeah, that's great, and you don't tell them that there's a ghost in the attic, then you're just going to hit their bid and and sell it to them at their at their price. You're being the aggressive seller. If the person bought it from you at $700,000, they're the aggressive buyer. But when they're sitting on the bid at $600,000, they're passive. They're a passive buyer. And when you're on the offer at $700,000, you're a passive seller. Why do I got a lot of pictures of fish? Well, every day, we're sort of confronted with a passive and aggressive selling. I'll say passive aggressive. It sounds like a psychological problem, but we deal in terms of order flow every day. And in America, there's not many fish markets that people go to, but in a lot of the world, when you're buying your fish, your meat, your vegetables, you go to a market. And imagine, put yourself in the position of the fish seller in the market. They have an inventory that's sort of on a not declining, but is perishable, and over time it's going to become less and less valuable. So early in the morning when he's got a lot of stock, he could probably sell it at a little bit higher price when it's still fresh. So he's willing to sell his tilapia at whatever, $3 a pound. Okay, and everyone's coming in thinking, wow, this is great tilapia, great fish. I'm going to come in, I'm going to buy it. I'm going to pay $3. The people that are buying it at that time are being aggressive. They're willing to pay the market price. As the day goes on, the guy, his fish is just sort of sitting there, his ice is melting. People still want to buy fish, but, they don't probably want to buy it at, at $3 a pound. So, the guy, he lowers his price. He's looking for a bid to hit, so instead of $3, he goes down to $2.50. Okay, then someone comes by, hey, I like this, I'll buy 5 pounds, but can you give it to me for $2 a pound? And the fish guy thinks, hey, I want to get rid of this inventory, go home. Yeah, sure, $2 a pound, and boom, he hits your bid, and you go away with the fish. You're the passive buyer. The fish seller was the aggressive seller because he met you at your bid. So, the point is there's different types of buyers and sellers. Everyone has their own reason for trading in the market. And, it doesn't matter. You can sit here and say, oh, this is a hedge or this, that. It doesn't matter. At the end of the day, people are buying, people are selling. You want to be able to, ideally, you'd like to be able to determine, are people buying or are, people selling? Okay, let me step that back because that sounds very confusing. People are always buying, people are always selling. But when people buy from the offer, right, just remember, that's being aggressive. A market order is an aggressive action. A bid or an offer, a limit order, a limit bid, a limit order, either on the bid or on the offer, is passive. So, there's another thing that I'll get into a little bit, not in this presentation, but in a different presentation, is imbalances, is when you have more aggressive buying or more aggressive selling. That's these blue numbers. When you're seeing a lot of blue numbers, you see people are being extremely aggressive, and it's causing market imbalances. And market imbalances is what causes the market to move pretty quick. You can see as you're going up a lot of blue numbers, people are being super aggressive, causing market imbalances, and the market's going up. It's just literally you see up, 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 from this price at 62, where it starts, you got a big imbalance here at 287, and the next bar you got a bunch more imbalances, more imbalances, more imbalances. It's not till you're 6 points higher that you start to see some, a selling imbalance, some aggressive, strongly aggressive selling come into the market. So again, really quick to sum up, what's aggressive behavior? Market orders. What's passive behavior in the market? Limit orders. And say for example, hey, you get a trading signal, right? And it says to buy here. You get an arrow. A lot of symbol. A lot of trading indicators just give you arrows, or the blue line or something. So okay, say you get an indication here to buy. Okay, well, there's two types of orders you're going to work. You're going to work either a market order, or you're going to work either a bid. Well, if you're buying, you're going to work a bid. And if you want to get it done, get into the position, you use a market order. So you have your signal kickoff here, market's trading, up here at 65, and you got two choices. Do I just get in? Do I pay the market price at 65 or 65 and a quarter? Or do I try and finesse it, and wait for a pullback down to 64 and I put a limit in? If you put a limit in, you're being passive. You're letting the market come to you. If you're buying at the market up here at 65, 65 and a quarter, you're being aggressive. You want to get into this position. You're willing to give up the edge, so to speak, the edge on, the scalpers, what they refer to as the edge, is either buying on the bid or selling on the offer. So, if you're trying to buy it, waiting for a pullback down to 64, there's a chance you may not get it, but you're being passive, right? You're saying, well, if the market's going to come to me, yeah, I want to get into this trade. But, if you just go ahead and say, damn the torpedoes, I need to get in, this market's going to take off, you're going to pay the market. That's being aggressive. So, again, think of it in the sense of, passive, you let the market come to you. Aggressive, you go to the market price. Again, think of it as in everyday terms. It's sometimes, like I said, we all go through it every day and you just don't realize it. Say, for example, you go to buy a car and, some guy's got a nice Corvette for sale. And, the guy doesn't really want to sell it, but he's got a high price on it. Usually that's how you can tell people don't want to sell stuff, is if they price it high. Well, either that or, they have no concept of how a market works. But, sometimes, people they're willing to sell something, but, at a high price, because maybe they don't want to let it go. But if someone's willing to pay, a high price, yeah, they'll sell it. So, and you're a Corvette lover, you just got to have this Corvette. And, the guy, say, hey, yeah, I'll sell you this Z06 or whatever for, 125,000, even though you could go to the dealer, buy it for 100,000, but you got to sit on a waiting list for 6 months. What do you want to do? Are you going to be aggressive or are you going to be passive? If you're going to be passive, you join the waiting list at the dealer for the car. If you're going to be aggressive, you buy the guy's car for $125,000. You pay, you pay the market price. You pay an extra $25,000. You're being aggressive in that sense. If you wanted to be a passive buyer, you just join the waiting list for it. So, hopefully now I think you can understand what the difference is between aggressive buyers and aggressive sellers, and passive buyers and passive sellers. Again, just think of it in everyday terms. We all deal with this stuff on a daily basis. It's a matter of understanding it in the market. A lot of people aren't able to connect those dots. But what I'm trying to do is at least just give you a little bit of something that so you can understand it a little bit better. So thanks for watching this video. To learn more about the trading software used in this presentation, these charts, there's a lot more to it than just the footprint chart. And also to learn how you can profit from order flow trading, visit my website www.orderflows.com. And subscribe to our YouTube channel. We got a lot of videos, a lot of instructional videos. And send me an email if you want. My email is on the website, orderflows.com. So thank you.